Welcome into the show. It's a good day to talk money because expert Phil Bloyd is here to help us out. This is Lowcountry Money Talk, and we're going to talk through some things going on. Nice to see you.
Good to see you, Jessa.
Phil, of course, is with Revolutionary Financial Group, and we always have a lot to discuss.
Yes, a lot of stuff going on these days.
This is going to be a really interesting show, though, I got to tell our viewers, because we have a lot to really sort of unpack throughout this whole episode, and there's a theme. So, of course, we're talking about retirement planning. A lot of our viewers, know that this is an essential topic for us, and with the recent market volatility, of course, inflation, recession concerns, there's a lot on our minds.
Yeah, we're not out of the woods yet.
We're not. We're ready to be, but we're not. But here's the good news for you. We're going to talk about the 4 Ds of retirement planning.
Sure.
And each segment throughout this show, we're going to kind of unpack each one.
Yeah.
So I would love for you to kick us off, Phil, with number 1, which is diversification.
Yeah, that's a word that's probably used way too much, but diversify. So a lot of people they think, well, if I diversify my investments, if I diversify the type of investment, maybe that will help. And that's typically, the thought of Wall Street. Yeah, we'll diversify things. We don't want too much in one stock. That's pretty smart. Maybe we don't want too much in one classification. Maybe we want stocks and bonds. Some squirrely things going. I'm going to use a technical term. Squirrely. That's a very technical term.
I love your terms.
Okay.
That's good.
So, there's some very squirrely things going on with bonds these days because the Fed is stimulating. So, or raising rates, let's say. They put out all this stimulus and cash into the system, and now we've started into inflation, and we've been there for a while, right? We've been talking about that for how long, right?
Yeah, long time.
Okay, inflation. Yeah. So now they're trying to pull back on the inflation by raising the interest rates. Well, that's a little tricky for bonds. So people look at their statements and they're like, well, it looks like my bonds are down in value. How does that happen?
Right.
Let me just run something by you. Let's say you bought a bond 3 years ago, a treasury bond, and it's paying 2%.
Okay.
The new ones are paying 4 or 5.
I see.
You want to sell me your 2%? Well, it's not worth much.
No.
So we look at Silicon Valley Bank. That's something that happened in the news lately. They had these 30-year mortgages at low interest rates, and they also had long-term treasuries. And then they had a run on their bank. They had a lot of people pulling out deposits, and they had to come up with that money somewhere. So they had to cash out these long-term positions that were paying low rates, and nobody wants them.
No, yes.
So you have to sell them. When we talk about those haircuts, right?
There's another technical term for you.
So we have to sell them at a haircut or a loss. And, they lost, I think, $2 billion in cashing out early. So this also happens with you. Wow. So, if we talk about we've heard the 60-40 plan being 60% stocks, 40% bonds. This has been an old go-to on Wall Street for decades. Over the last 10 years, maybe that portfolio will return about 11%. Most analysts are predicting going forward that same 60-40 over the next 10 years may only produce about 5%.
Oh my.
So do you want to risk 60% of your holdings for 5%? Probably not.
No, that doesn't sound good at all.
A lot of the things we have going on now go back to 1969 when I was 4. I don't think you were even around.
No, not yet.
Okay.
Not yet.
So the two economies look very similar. We had energy issues. Now we see gas prices going back up. Saudi Arabia and OPEC have lowered production. They're kind of mad at us. So we're going to deal with that all summer. We had a war in Vietnam, 69 and 70. There's a war in Ukraine now. We had a recession coming on. The interest rates were up. The Federal Reserve was raising interest. A lot of similar history repeating itself.
Yeah.
But the one thing I would talk about is we talk about a client that may come in and say, hey, I'm looking at my statement and my bonds are down and all this kind of stuff. it's really important that we follow that rule of 100. In the 30% or so, let's say if we're 70 and I want those in individual equities, they need to be in individual equities or money market. We don't want to tie those up in bonds because the bonds don't have any liquidity in this typical market here.
Right, so you want to be able to access it is one thing. We got a money lesson and a history lesson all in one segment.
That was fast.
How did you do that?
I don't know.
But the good thing to remember, though, that because of all these changes, and of course the investment world is just it's tricky right now, and the past few years in particular, it's a great time to really just review your retirement plans, especially if you're wondering if you're going to have enough money, if it's going to last you. So you can start today by getting a complimentary revolutionary wealth review. Call Rachel at the office. She'll get you scheduled. It's a great time to do that. And we have 3 more Ds for you coming up on Lowcountry Money Talk. We'll be right back.